Our next guest says pouring liquidity into the market will once again fuel an asset bubble. Joining us now via webcam from Hong Kong is Richard Harris, CEO of Port Shelter Investment Management. Richard, always great to have you. Always great to get your insights, especially when something that has, I guess, a bold call like that. Did you think that maybe perhaps central banks have overstepped a bit? Is that what you're alluding to?
Well, I'm certainly not saying it's going to happen tomorrow. In fact, what I think is we may see another down leg, because we've seen a big chunk of good news with the announcements of the increased stimulus. And after that, it's going to take some time for that money to actually reach people. But I think looking further out, you have to think that these are extraordinary sums of money. You're looking at, what, 2.2 trillion from the US, another trillion announced by Germany, 800 announced by Europe. By the time you add up China and Japan as well, we're going to see an enormous stimulus to the global economy, something in the order of bringing in another Japan. It already exceeds the GDP of Japan. So you're looking at adding the third largest economy to money that will actually end up in the stock market. So you have to think that we're going to have inflation in asset prices all over again.
But didn't the Fed have to do something? I mean, was it necessary, at least, in bringing down the dollar, for example, this insatiable demand that we saw for dollar? Is there a sense that they need to do this to at least alleviate some of the funding stresses we see out there?
Well, a whole bunch of reasons to bring the currency back down. And don't forget, it's a great deal weaker than it was in the global financial crisis, if you look at the dollar index. So I'm not too sure it was the dollar. Yes, governments are very concerned about increase in unemployment. And that's going to be a major issue. They've decided to deal with it by trying to pump money into the economy, to pump money into companies. And that's true, and that's the strategy. But you have to wonder, maybe the unemployment benefit route would have been a better way than just throwing money at the economy and, say, to hang all the consequences that may happen later on.
Richard, damn if you do, damn if you don't. I mean, you talk about how trillions are being thrown in, but these are extraordinary times.
They are. We're at a time when we're seeing economies close down at a time you would never really even see in wartime. We've got something like 2.3 billion people under lockdown. That's whatever, a quarter of the world's population. It is absolutely unsustainable. And I think that perhaps the narrative is going to move from the containment narrative, which China began with and which has spread around the world, to maybe saying, well, perhaps we ought to have some herd immunity. And this looks as if this is what China's doing. Xi Jinping said, we've got to get back to work. And maybe the relative lack of information about casualties coming out of China is an indication of that. But perhaps we need to go to protecting the vulnerable. We know enough about the disease now to know that. And looking at the community, developing a herd immunity. If that policy change happened, we'd see the market shoot up.
And Richard, the credit market has broken down. Do we look towards the credit market for any indication that the crisis is over?
Well, that's very interesting, because last week we had this unusual situation of the equity markets tanking, gold falling, and bonds falling as well, which seemed to indicate that people were basically selling everything for cash, to raise money for margin calls and this sort of thing. What's happened in the last few days is the bond markets have actually improved. Gold has started to tick up, which actually is a positive sign, I think, that people aren't rushing around for cold, hard cash. That, of course, is part of the reason why the Fed and other central banks have gone into putting liquidity into the economy, to try and cut that credit crunch dead. And if that's what they've done, then that's fine. Maybe they oughtn't put the money into the market now, but if that's fine. But I think that normally you'd see gold go up, bonds continue to appreciate while these equity markets were going down.
And Richard, I mean, you mentioned about there longer term, there is, I guess, a risk here of the Fed overstepping or at least doing too much when it comes to liquidity. I'm just wondering then, how soon can they get out of this? How soon could the Fed get off zero interest rates? And you look at overnight index swaps. It seems like they're pricing in Fed funds stuck at zero for at least 2 years. It took 7 years for the Fed to get off zero after the global financial crisis.
Well, I think one of the problems is that central banks now can't really take on the idea that maybe every now and then the world needs to go into recession, that we can't have money at zero all the time. Money has to cost something. Otherwise, we end up with a whole swathe of zombie economies that don't particularly, zombie companies that don't particularly work when there's a downturn. So we're going to have to get to some sort of stage, and maybe this is the time to clear out the kitchen sink, where money now has to be priced properly with interest rates up, where we have to see a clear out of the economy of zombie companies, and where we're in a situation where capitalism is working again, because with this massive nationalization, and I'm not being political here, with this massive nationalization of what's been happening, all we're going to see is governments continually supporting the private sector.
Richard, back in February, you said that your top 3 ideas were long bond, gold, and gold stocks. Are you still sticking to that?
Yes, I think so. I think that, you know, at the moment, it's very difficult to sort of say change strategy because we don't really know where the markets are going. I mean, the best thing for most investors to do, if you don't need the cash, is to sit on your hands and just wait it out, see where things are going. Because, you know, if you didn't fix the roof and the sun was shining, it's too late now. But I think looking further out, you know, gold is still interesting, especially if we're going to see an asset bubble. Equities, especially in some of the interesting areas. Farmers, of course, have to be interesting now. Tech, I think, is going to continue to be interesting. All of these sort of things are probably where you should be. And even the bond market.